Crisci, Fairway Mortgage. It's good to finally have you back on, my friend. We tried to
Good to
do
be.
this over a year ago and forgot to hit the record button. I did.
Well, it's good to be back. No, I'm excited to talk about some rental properties here and what financing looks like with it.
Yeah, and we're going to jump into that. And for those of you who don't know, Tyler is my go-to lender for all things residential financing, which in my world is everything from the single family up to the 4-unit property. And I wanted to have Tyler back on to really talk about that process, talk about those qualifications. But before we start, I kind of want to open up with a broader question. We're in a time when obviously interest rates are higher than what they've been in the past. They're not at extremely high levels historically, but they went up pretty much straight in the last 12 to 18 months. And we're certainly monitoring the Fed. And Tyler, we just left a meeting where you gave a talk on what's going on with the Fed. So I would say go up to your 30,000 foot level on the mortgage horizon. And what are you seeing in your world right now with I guess more on a national level, the mortgage interest rates and the lending scene?
Yeah. Well, I mean, mortgage rates have been on a ride for the last couple of years, right? I mean, think back to 2020 and 2021 when everything was at 2 and 3%, and now those days seem like they were forever ago. And we're up in the mid sixes right now. And we just got to the mid sixes. So it's like, think about 6 months ago, we were in the high sevens. I remember writing mortgages for people in October of 2023 for over 8% for a primary residence. So, thinking about an investment property at that point, that was like up in the nines.
Wow.
And now today, we're looking at somewhere around 6.5 for these primary mortgages, primary residences. And, for second homes and investment properties, you're in the sevens now, at least for the conventional guidelines, for conventional loans. But huge difference as opposed to October, and then even bigger difference as opposed to a couple of years ago. As we kind of go further into what the Fed's doing, obviously they raise the federal funds rate rapidly, right, to try to combat inflation. Now that inflation has seemed to calm down, there have been very, I want to say hawkish, I guess is the right word, on bringing that down. And they're just kind of starting to get a little more dovish on it. As Jerome Powell spoke yesterday, he had some pretty encouraging words at the end of it, during his press conference, that really points to them starting to bring that federal funds rate back down in September. And the big question that's on everyone's mind is, how much are they going to do that? Is it going to be a 25 basis point reduction? Is it a 50 basis point reduction? Some people say it's going to be a 75 basis point reduction. I don't really see that, but I think it's going to be somewhere at 25 to 50. I'd probably bet money on the 25, depending on what happens with the labor market, because really they're not so much looking at inflation anymore. They're looking at the labor market. So, what are these jobs numbers that have been coming over the past, 2 years, that some of them have been pretty wildly inaccurate, a lot of revisions done to them. But now it looks like they're kind of starting to show what's actually going on in the economy, and that's forcing, Jerome and the Fed to really look at the stance that they have on how quickly they're going to lower these interest rates. So, over the 30,000 foot view, is we've been coming down very, very, very slowly. It kind of seems like we took an elevator up and we're taking the stairs back down. So as that kind of starts to snowball and, we start to come down more, hopefully we decrease rates a little bit more rapidly. I would say that, by the end of the year, we should be in the low sixes, like 6.25, 6 1/8. And that would be welcomed compared to, what we've dealt with the last year.
What rate would you say would be a good stabilized rate? I mean, obviously it can't go on as 2 and 3%.
No, yeah.
Historically, I think when, back in the great financial crisis, the Great Recession, rates were somewhere around 5 to 6%. What would you as a lender, based on the numbers you're seeing out there, especially with prices being where they're at, would be an
I mean,
acceptable rate?
yeah, I mean, given that, that's what I was going to say, is where prices are at, I would love like 4 to 5%. But the reality is 5 to 6 is a healthy market. I mean, that's what most experts say. And I agree with that. Everyone who witnessed or heard of or had an aunt, uncle, grandma buying a house at, 2, 3%, like unfortunately that was an anomaly. And if you look at, the last 50 years and you look at a graph of where rates are, you would very clearly be able to see that that was a complete anomaly. And it's not something that will or really should happen ever again.
Yeah.
Especially if you look at the factors of what went into it.
Yeah, absolutely. So if we ever go back there, it'll be nice, but don't hold your breath. One last question on interest rates. A lot of times a job report will come out and we'll hear that there was a big, plus or minus in the interest rates the following day. And I know we all
Mhm.
talk about the Fed adjusting interest rates, which it's not really their 30-year fixed rate, right? It's always their Fed funds rate, which kind of affects interest rates. But
Right.
how does the job market affect interest rates? If we get let's say a jobs report where the unemployment rate has risen quite a bit, would that cause rates to go up or down for 30-year fixed mortgages?
Most likely down. Again, there's not a direct correlation. Like you're banking on what the investors are going to do with the bond market, right?
Right.
So if you're seeing that the unemployment rate is going up, that means a slower job economy, which means that the rate hikes that the Fed did and in order to slow our economy down are working. And the fact that people are losing their job isn't necessarily a good thing at all, but it does show that the economy is slowing down. And when the economy is slowing down, that kind of points to them going or doing a reduction in the federal funds rate, which the investors will look at as, okay, if they're going to reduce the federal funds rate, mortgage rates will go down. So getting ahead of that, you'll see that mortgage rates will react generously to a quote unquote bad unemployment rate.
It seems to me that it also they they seem to go interest rates drop when the stock market drops. So it seems like maybe bad news is good for low interest rates. Is that kind of how it
Yeah,
plays out?
honestly, you know what? It feels like, at least in my opinion, that they used to be correlated a lot more. Like when the stock market did good, like, bonds typically did bad.
Right.
And I will say, like, it's gotten harder to say that over the last year, 2 years. Really ever since COVID, actually, now that I'm thinking about it. But it used to be a lot more like, when we look at our screen every morning on MBS Highway, which is a tool that almost every loan officer has, it has, what the S&P is doing, the mortgage-backed securities and the 10-year. And every time, it's kind of a hit or miss with like if they're going to match up, yes or no. Um, but it used to be that way. I would say, there's some factor in it. Like obviously, if there's a lot of money getting influxed to bonds, like you can totally expect rates to improve. And secondly, if like nobody's buying bonds, then you could probably suspect that rates are going up.
Good info. Why don't we pivot now to getting mortgages for investment properties? Because that's really primarily who's
Yeah.
listening to this program. So, loan products, we're talking investment properties, generally 1 to 4 units. We're not talking about apartments over 5 units because that becomes commercial. So, we're
Mhm.
primarily focused on residential. What kind of loans are available for rental properties? Single family rentals, duplex, triplex, fourplex properties.
Yeah. So like you were saying, anything up to 4 units is what our bread and butter is. With investment properties, there's a couple different ways you can go with those. I mean, one, you have your traditional run-of-the-mill conventional loan that's used by most investors that typically yields you the cheapest rate, at least from like a loan officer standpoint. I know that you can do private lending and you have seller finance, all that stuff that's a little more complicated that we don't really touch as loan officers. But in a loan officer's position, if I'm looking at like what's going to give you the cheapest rate, that's a conventional loan. Now, there's other options that go because qualifying for a conventional loan can sometimes be difficult, especially for seasoned investors that own multiple properties. If you own 10 properties that all 10 have a loan on them, unfortunately, you can't get a conventional loan anymore. So
Is
the
11
other,
the max?
yeah, 10 is the max.
10 is the max. Okay.
10. So the other avenue that we have are something called a debt service coverage ratio or DSCR, which is super popular again with the investor community. And I really like these loans for investors because it cuts down on a ton of time and a ton of paperwork. And so what it means basically is whatever the payment is on the property, which would be your PITI or principal, interest, taxes, and insurance versus what the rental or what the rents are. And it's calculated a couple different ways depending on where you're at with the asset. If you're buying a new property and there's not a tenant in there, um, then they're going to go off of what's on the appraisal. And we can talk about that in just in a second, but they give you current market rents, basically, whatever the appraiser's opinion is on that based upon data. Um, and then from there, you'd look and see what's the ratio. Is it 1-to-1, meaning it's, the payment's $3,000 and the rents are $3,000, or is it a little skewed where you maybe, the payment is $4,000 and the rents are only $3,000? There are loan products that can get away with that, and that ratio just determines what the rate is. But there's no income qualification, nothing like that. There's still reserve requirements for your assets, but at the same time, it's so much easier because if you qualify or you've got that rent just above what the payment is, it's done. You're qualified. There's no underwriting that goes into your income or anything like that.
So why would an investor use a DSCR loan versus just conventional financing? Is it because they might have problems getting the debt to income ratios in line on using their personal finances?
Yeah, most of the time, savvy investors know how to do their taxes, right? And, the way you do your taxes can have a big influence on if you qualify for a program or not. For example, just staying on the rental side, right? If you have your rental and you're filling out a Schedule E for your rental, we're going to take the bottom line figure that you made versus how much rents were in there. And that bottom line figure could have a lot of things taken out of it, right? If you look at a Schedule E, you've got, insurance, depreciation, mortgage interest, repairs, all those line items that are on your tax return form, that gets deducted from what that final figure is. And so to add things back into there, we can add things back like insurance, taxes, property taxes, mortgage interest, depletion, depreciation. All those things go back into that figure. But if you write off repairs, I mean, those are harder to get put back in there. So you might have a property that's cash flowing. In fact, I can think of a really good example, an Airbnb. You might have an Airbnb that makes you quite a bit of money, but if you write off a ton because you did a ton of repairs to it, that property might be shot that year and you might be at a negative, even though you probably made, $50,000, $60,000 off this property. On paper, it doesn't look like that.
Hmm.
So that's one way that you could potentially not qualify for a conventional loan. Same thing with like a business, right? A Schedule C business, whether you've got separate tax returns for that or not, whatever the bottom line figure is, that's what they're looking at in a conventional loan. And that can present a problem to somebody who's savvy with their taxes and knows what to write off. And I don't want to say to avoid paying taxes, but to minimize their tax stance, I guess.
So it's more like a commercial loan, because in commercial, what the lender will do the property will have to qualify, which is through a debt service coverage ratio. Usually it's
Mm-hmm.
1.2% when we underwrite commercial loans. And what you're saying is that's the difference here is either the property's qualifying on its own income or the conventional way is that the investor has to qualify on their income, which is what makes it more valuable. Are they higher interest rates? I mean, are there any negatives to the DSCR loans? Because it sounds like it's be a pretty popular loan for investors.
Yeah, and it's becoming more popular. The interest rate should be a little bit higher, but here's what's happened over the last couple of months is these has gotten more popular. At least what I'm seeing, interest rates have been significantly lower. I mean, they're pricing out a, run-of-the-mill conventional loan. I mean, they don't charge any points, and most of the time these DSCR loans come with points, but a no points, conventional loan, it's probably, high sevens, maybe low eights, depending on what your credit score is and what your debt to income ratio is. But if you do a DSCR and you might pay a point or two, but they're at like 7.5 right now. And so, you might get 3/8 of a rate difference between the conventional loan and the DSCR, depending on what bank and what product you're using, right? Also, the big factor is the actual debt service ratio, right? If you have a debt service ratio of 0.75, your interest rate is going to be higher than somebody who has a debt ratio of 1.2. and that's really how they kind of calculate it. They're the rate, we call them LLPAs or loan level pricing adjustments in the conventional side. The non-QM pricing adjustments happen for a DSCR loan at your credit score and what the ratio is.
When someone is buying a fourplex and they're planning on living in one of the units, could they use a DSCR and it be partially owner occupied?
No, not a, so for a DSCR loan, you have to be fully in, you cannot be living in the property.
Fully non-owner occupied.
Yeah, you can do that with a conventional loan, sure. If you get a conventional loan in there, you can count all three of the other units towards your qualifying income, which is a huge hack for, all those people who want to do like a house hack, or, if I could go back in time and redo my first property, I would buy I'd buy a 4 unit too and live in one of them.
Sure. Sure. If you could get your wife to live in a unit,
Yeah, I don't think she was
that's the
super
hard
up for
part.
that at the time, but I think I could have tried harder to convince her, knowing
Yeah.
what I know now.
So, what are the down payment requirements on investment properties versus your owner occupied property? I mean, barring the fact that you can do, these days there's grant programs that are 100% financing, which I hope they never bring back because that's what torpedoed us back in 2008, essentially. But
Yeah.
you've got FHA loans, you have VA loans, but for the most part, people will think 20% down. What are people looking at when they're considering an investment property?
Yeah, so I mean, first off, there's not a ton of grant programs for investment properties. And in fact, I don't really know if there's any. Those are mainly reserved for now, the primary residence for first-time home buyers. But let's talk about, instead of just saying down payment, I want to like bring up like the way of looking at it is loan to value, right? So when you have a loan to value, like let's say your loan to value is 85, that means you have 85% of your property is a loan, or 85%, and the 15% is value. So, for example, $1 million property at an 85% loan to value means that they have an $850,000 loan and $150,000 in equity.
Right.
So keep that in mind when you're looking at a single unit, because this is broken down into units for investment properties. The down payment for your first investment property is only 15% down, or an 85% loan to value is what you need to have.
Okay.
So if you're a brand new investor, let's say you own a home and you're like, hey, I really want to buy a condo and start cash flowing or start, building my rental portfolio, your first one can be done at 15% down. And then after that, it's 25%. Now, the reason I said I wanted, before I get into that, let's go to the 2, 3, and 4 units. So again, 1 unit's 15% down, 2, 3, and 4 units, they start at 25.
So a minimum of 25% down on the duplex, triplex, fourplex properties, regardless of what you're getting qualified for.
Exactly. And then just to take it a little bit of a step further, the reason I said loan to value is because if you are somebody who owns one of these properties, you need to be aware that the requirement for what you're going to, if you want to refinance, like let's say you bought and then rates dropped and you want to refinance, there is a loan to value requirement for taking cash out. There's a loan to value requirement for just doing a rate and term refinance. The rate and term refinance, you have to have 25% equity. You have to be at a 75% loan to value or lower. So if you just bought the property and rates drop and you only put down 15%, you might not be able to refinance right away.
It's got to get to 25%.
Exactly. And then with a cash out refinance, for a single unit, it's at 25%, but for the 2 to 4 units, you can only go up to 30%, or sorry, 70% loan to value. So again, let's use $1 million as our example again. You have $1 million home, let's say it's a duplex, and you owe 500,000 on it, and you're like, hey, I'd really like to take some cash out to buy another investment property. You can only take 200,000 because that will put you at 700,000 off of $1 million property, which is a 70% loan to value.
Understood. So there's some loan to value limitations. So, there used to be a motto, uh, marry the house, date the rate. And I don't know if that motto was too good of one. I'm glad it was left back in 2022. But that being said, is there any sort of time limit to get that additional equity? In other words, Does it have to season on the market after a purchase before you can do any sort of rate and term refinance for if you were to able to get to go from that 15 to say 25 or 30% equity?
Yeah, typically you need 12 months seasoning. You
12
need
months
about a
seasoning.
year.
Okay,
Yeah.
got it. So you got to read for a year. And the only reason I ask is because what springs to mind is someone doing maybe a stabilization of a property, or they're buying a value add property and they're going to go in, they're going to maybe take some vacant units and clean them up, increase rents. And so that really leads to my next question is, if that's the case, does the 12-month seasoning also apply if the appraiser comes in and says, okay, these units are now able to rent at a higher rate? Do you get to use that income in the valuation of the property?
So I mean, it kind of like is a two-pronged thing. And I guess I should back up and say that the seasoning requirement is for conventional loans,
Okay,
not for the DSCR. So the DSCR, it works a little bit differently. And each bank, think of DSCR as a portfolio product. Like different banks offer different rates for it. They have different guidelines. Some of them
sure.
don't go down to this 0.75. Some of them do. But so I would say check with the bank that time. But to answer your question, no, I'm just blanked on what I was
Well,
going to
the
say.
question is,
But can you repeat the question?
if we have to stabilize, I even forgot what it was. Well, just because as an aside, when we talk about loans, everything's changing. Everything changes on a regular basis. So we're trying to stay within Fannie Freddie
Mhm.
Ginnie Mae guidelines here, but there's bank overlays and everybody has their own flavor. So I think the listeners should understand that this is all going to be relative or subjective to your individual situation, which is
Right.
just the nature of the business. But it begs to question, if someone buys a dump, a real beater, and they want to turn it around and stabilize it, will they be able to turn around and refinance that property within the 12-month period, as long as they're getting new rents? Maybe they moved out tenants, they raised rents, and we're able to get more value. Are they able to then do the refinance? Or maybe it leads to our question on, what is the appraiser going to use for the rents?
Yeah, absolutely. So I mean, with conventional loans, there's something called delayed financing. So that could be something that like, hey, you bought it in all cash and then you're trying to get the cash back out to you. And I have the guideline already pulled up right here. I can just read it out loud. Borrowers who purchase a subject property within the past 6 months, and this is measured from the date the property was purchased to the disbursement date of the new mortgage, are eligible for a cash out refinance if they meet the following requirements. So again, it's always different, but for this is conventional loans. The original transaction needs to be an arm's length, so you can't have bought it from a family member. The borrower may have initially purchased the property as the following: one natural person, so just as yourself, an LLC, or an eligible trust. Um, Again, another requirement is the source of funds for the purchase transaction are documented. So could be a hard money loan, could be just cash that you have on hand. And the last one is the new loan amount can be no more than the actual documented amount of the borrower's initial investment in purchasing the property, plus the financing of closing costs, prepaid fees, and points on the new mortgage.
Okay, so there you go. So it's doable. And
Yeah, it is doable for sure.
we're kind of towards wrapping up here, but a couple questions again is, so the appraised value on a standard loan can include market rents, correct? You can go off of, because many owners that are selling don't have market rents, and rents have gone up very quickly. For
Mhm.
that valuation on a standard loan, not a DSCR loan, conventional, you are able to use the market rents that the appraiser puts into it, or are they looking for a rent roll of actual rents?
No, I mean it depends. Like if you're inheriting tenants and they're paying a premium, like that's a good thing. And you can try to get away with that. And depending on how long those existing leases are in place for. But most of the time, I'd say 90% of the time, it's the appraiser going out there and saying like, hey, here's what I found in the area that it's renting for in the area. This is my opinion on what it should rent for with current market rents. And most of the time, even with DSCRs, they'll use the lower of the two. So if you have like a lease agreement in place and then the appraiser goes out there and gives them current market rents, they're just going to say whatever one's lower, we're going to use.
Mm, understood. I thought they always used market rents, but it doesn't sound like that is the case.
No, yeah, again, like if you have a lease expiring in a month, like they're not going to let you use that. But if you have something that's like a year that they just signed, then you have a chance of getting away with that.
Yeah, generally, we're seeing leases are just month to month,
Right.
so
So they
they
would,
are, yeah. Well, and month, every lease that expires goes into a month to month
right.
rental agreement. So uh, it'll be interesting to see. I guess it maybe even require a letter the from the seller showing that maybe the tenants lived there for 5 years and the lease expired 5 years ago. So
Yeah. And I think you have to remember too, the spirit of a conditional, like a, or a conventional loan, like when it's being underwritten, is that you're established and you're an investor. So, I mean, there's reserve requirements where you're going to need extra cash on the side. It doesn't need to be in liquid, but like they're going to make sure that you have 6 months reserves. They're going to, anything that they can do to like make sure that you're in a like more risk adverse position, they're going to have that kind of guideline. So you just have to keep that in mind. Like if you're kind of like riding thin and like you're not sure if you're going to qualify or not, or you're not sure like what like the rent's going to look like, you're probably better off with a DSCR loan, because a conventional loan is just going to have tougher guidelines just because of the spirit of how they underwrite those loans.
with regards to the reserves, can those reserves be in, say, a 401k or could they
Mhm.
be in an IRA?
Yep, they can be, as long they don't need to be liquid. Like I said, they can be vested in stock options. They could be in your 401k. They could be whatever you have as far as where you keep your money is typically usable. Um, there are certain situations and certain kinds of accounts that they don't like, but as long as you have like a vested amount, like again, and it's not going to be something crazy. It's just 6 months of whatever the payment is. So, like I said, your payment's $4,000. They just want to see 24 grand in a bank account somewhere.
Tyler, as we wrap up, any recommendations for folks that are maybe looking to buy their first rental property or looking to increase their portfolio from a lender's standpoint?
Yeah, I'd say it's easier than you think. One of the biggest questions that I get asked nowadays because of how high interest rates have gone up is how can I take equity out of my property to buy another property? So I mean, every situation's different, right? And there's multiple options for people, whether it's a second mortgage, HELOC, anything like that, et cetera. But when you are looking at buying a home, you have other options, and a lot of people think get stuck in that 25%. And that's just not the case. So I would highly suggest reaching out to somebody like myself or a loan officer in your community and just asking them, what are the rates look like? What do the payment looks like? What do I need to do? Because I mean, with things like the DSCR program, I think it opens up a window of opportunity for a lot of people that they may not have had.
Final question on DSCR. What is the debt service coverage ratio that they're looking for?
One would be ideal. And
One?
yeah, just as long as it matches, or the rent is more, that's fantastic. I mean, you are golden at that point. And again, we still have other investors and banks that will go down below that. But that's the biggest caveat. I mean, obviously, too, you need to have a decent credit score. I would say 680 or above will get the job done for you. Um, but if not, then I'd look into kind of raising that credit score because it's going to affect the rate, which ultimately will affect the ratio too.
Good to know. Well, Tyler, thanks for being on. We're going to have you back again, maybe quarterly, because you bring a lot of insight, and I appreciate uh, all that you bring as far as the investment property knowledge for loans.
Yeah, thank you very much. And if you guys ever need anything, you know where to find me.
Yeah, we're going to put Tyler's contact information in the description below. And for those that are in probably many states, are you licensed in multiple states at this point?
Yeah, exactly. And our company, I won't say our company is in negotiations for buying a bank that would open up the rest of the United States to us. So I'm licensed in 7 states right now. However, if you need something done in a state that I'm not licensed at, it is really easy to get licensed there, and we might already be on the way to be doing that. So
There you go, Tyler Crisci. I appreciate you. And I do recommend Tyler. I've used him for many of my clients, even family members. So we'll put his contact information below. And if you have any questions, reach out. Thanks a
Thanks,
lot,
Doug.
Tyler. Take care.
You too.